Hey guys, it's Steve Lamont, the founder at Elevate Realty Group, and today we are going to talk about what the heck is going on with 8.5% interest rates. Let's break it down today and talk about, what we foresee happening as we go into the rest of the year. As interest rates have gone up this year, we've seen buyer demand slowly start to decrease. The average mortgage payment in today's world in the Sacramento region is probably around $4,000 a month. And that's on an average sale price somewhere in the range of $450,000. That's extremely expensive compared to, just 2 years ago, where the average mortgage payment was probably $2,600-$2,800. It's now cheaper to rent a home than it is to buy a home. Unless you have a lot of money to put down, most of the buyers in the market today have already sold a home, so they have a big down payment to lower their loan balances. But what in the world is driving these high 8+% interest rates? Interest rates on the 30-year fixed mortgages are at a 25-year high, and I don't anticipate that changing as we go into 2024. In fact, I would not be surprised if we see interest rates in the 9% range. If you go back to videos from the beginning of the year, I was anticipating this, not to toot my own horn, but it just made sense that we were going to see higher rates for a longer period of time. If we go back to our 75-year average, the average interest rate is somewhere around 8.5%. What's driving this? The economy is a lot stronger than the Fed thought it would be, so they're continuing to increase borrowing rates, right? On the last Fed meeting, they decided to hold, not increase short-term interest rate costs, and take a look at the data. Well, the data just came out about a week and a half ago. There was a really hot job market report. There were almost twice as many jobs created than what they had anticipated. And that's usually what drives the Fed's decision. If the economy and jobs are doing strong, the Fed is going to continue to drive interest rates higher, trying to slow and weaken the economy. The tool for the Fed to increase and decrease interest rates is really them trying to speed up or slow down the economy so that they can maintain jobless rates. They want to see unemployment near 4 to 6%, and it's currently sub 3% if you really look at it. And they want to keep inflation at 2%. Inflation adjusted for the CPI is actually closer to 4 to 6%. What does this all mean as we go into 2024? I would not be surprised if we see interest rates between 8 and 9% as we go into the beginning of the year. If you're a seller, I would highly advise you get your house on the market at the beginning of the year. I think we're going to see some trailing economic issues as we go into 2024. If you're a buyer, try to save up as much money as you can for down payment. I would not advise that you can refi later. I think that's a mistake. I would just get comfortable with your current mortgage payment. It's still fantastic to own a home. Compare that versus renting. I would always say if you're at a stage of life, if you can afford home ownership, I would buy a house. As always, visit our website at homesbyelevate.com. What in the heck? We have 8.5% interest rates. I think that if we stay focused on the future, we're all going to do great. You can also call us at 916-436-SELL. Thanks so much.